Welcome back to Dividend Investing with Lincoln. Hey look, I know for many people investing is scary. When you start thinking about investing in individual companies, you can get worried. And heck, once you see your companies plunge with stock prices dipping constantly day by day, taking dramatic, 15 or 20% drops in a day, it can be absolutely terrifying. So look, today we're going to talk about the core satellite approach. This is one way of taking some of the sting, some of the emotion, some of the worry, some of the fears out of investing. I love it. This is what I do, and this is what many people often find very useful. So investing is more than just numbers. Investing is also about emotion, about confidence, and about your own securities and feeling good about investing. So let's learn about the core satellite approach today to help you. Welcome back. So, you want to be a good dividend investor. Now, I know that investing is often talked about in quantitative terms. You're often talking about compounding annual growth rates or something technical like that, total return percentages. Even here on this webpage, we can see a lot of numbers. But investing is more than that as well, because inherently we have a lot of emotion involved in investing. Now, one of the nicest, cleanest, easiest ways that I know of to reduce a lot of that emotion while still having a lot of engagement in the investing process is taking a core and satellite approach. Now, if you think about this, the core is like a giant planet that is the bulk of your investing. It's safe, it's stable, it's steady. It's not requiring a lot of thought or consideration or worry or concern. Now that's the bulk, maybe 2/3 of your investment capital. Now, if you're thinking about what that means, if you're invested in, say, a total stock market fund, VOO or SPY, essentially what you're doing is you're mirroring the returns, say, of the Standard & Poor's representation of the value of the stock market. Now, we can argue about exactly what that core could consist of, but if you're just taking one of those sort of basic approaches like investing in the SPY, what this means is that you don't have to think about it, you don't have to worry about it, you know that your returns are matching the market returns. And so one of the other beautiful things about investing in a market-based fund like that, representing the total stock market, is it's more stable. Now, I know we're going through a bit of an economic downturn and prices are down, but in general, again, market funds often consist of sectors or groups of companies that are trading in different directions with the economic circumstances. Even while most companies are trading downwards, there are some sectors of the market and some companies that are trading up strongly on the news that they receive. So with a sort of a broad-based market fund like SPY, you've got stability. It takes a lot of the emotion out because you're not going to wake up the next morning, probably, and be down 20% or something. Now, on the other hand, if you flip this around and you were heavily invested, say, in Meta or Facebook, then it's highly possible that you could, in fact, be down and down heavy. If you had been invested in Meta platforms, you're invested at the peak, and you're invested and held it all the way down to today, you'd be down about 60%, which is quite a stiff decline and quite hard to stomach. And you can see that it wasn't a steady decline, it was punctuated with periods of extreme drops, such as this drop here from about $330 a share down to below $200 in a very short space of time. Now, emotionally, I know everyone says they can handle that. They think, hey, look, I'm going to be a great investor. I'm going to have a stomach of steel. The reality is, if you've got, years of work, years of saving, invested in the stock market, and you're seeing your money virtually evaporate often overnight because you've got your money invested in some companies where they're heavily affected by surprise news or surprise changes in market conditions, sounds easy to deal with. The reality is, emotionally, it's very hard for most people to handle that. So one of the beautiful things, though, if you're thinking about that core satellite approach, is you're often dealing with a very stable core holding. An example of this would be the SPY, basically investing in the 500 largest companies. Now, in a similar sort of perspective, from peak to trail, you'd be down only from the peak, sort of, just over a year ago, sort of thing, to today, you'd only be down about 15% on the SPY. So the core holding, then, you're looking for a diversified fund. It's going to have a lot of holdings. It's going to have less volatility, and that takes a lot of the emotion out. It takes a lot of the worry, a lot of the concern out. You don't want to be selling off after a huge drop because you're scared. So, core. Exchange traded fund, ETF, diversified, stable. Now, of course, here, SCHD, Swab US Dividend Equity ETF. So, ETF, we have diversification. This is good. We have a dividend yield as well. It's higher than the SPY. We have a relatively low expense ratio. We have investment mostly in US stocks of about 99%. We have a dividend yield of 3.2%, which is higher than the SPY of 1.6%. We have a strong 13% annual increase over the last 5 years in terms of that dividend yield. So a reasonable dividend yield, and it's also growing and compounding at a reasonable speed. So I do like the SPY. Is it suitable for a core holding? If you're really focused on dividend yield and dividend income, arguably, yes, this could be part of your core holding. However, it is not particularly diversified. So if you look here in the top holdings, top holding Merck, Amgen, IBM, and the percentages for these three alone, 4%, 4.6%, AVGO, Broadcom, 3.8%. So we're talking about quite a lot of concentration. So from memory, there's actually quite a large proportion here. Even if you look at these tickers here, these top holdings represent a large chunk of your investment in SCHD. So it does have a good dividend yield, it does have a good dividend growth rate, but it does lack concentration. So a lot of good things here about SCHD. I'll do a full video on that later. Is it a good part of the core holdings? Possibly, yes, but you might want to supplement it with other funds as well, and I'll do another video on creating a strong core later on. If this is useful to you, click the like, click the subscribe, and get more content, get more information, get more ideas with me soon. Learn more about dividend investing. So, core. What about the satellite? Well, the satellite part of the core satellite approach is quite simple, really. This is your opportunity to perhaps have a little bit of fun, get to know several companies more, it's your opportunity to invest in a high growth stock. It's your opportunity to invest in particular companies, perhaps in sectors that are really, you're passionate about. Maybe they're sectors you know a lot about. You might be investing in perhaps BDCs if you wanted to get some really nice additional income. So, for example, you might be investing in something like Main Street Capital. Now, Main Street Capital has increased dividends over time. We can see since 2007 through to 2022, almost a 450% total return. From this blue here, we see that a huge portion of that is actually dividend income. And in grey here, the price change as well. It's also had some good price appreciation. Is it a good option for you as part of your satellite? Well, it's hard to say. Perhaps yes. I mean, it's got a good dividend yield, which can be nice if you're into income. Dividend growth rate, 3%, not too shabby. And so a company like Main Street Capital could potentially be a really interesting satellite holding for you. Now, you do want to buy these satellites at a good time. You don't want to just go out buying stocks willy-nilly. Always look for good valuation. Always look to buy at a time when the prices are down relative to the earnings for that company, so that you can get in at a good price, hopefully make some good price appreciation. And if they pay a dividend when you get in at a lower price, you're also going to be picking it up at a nicer dividend yield, particularly for long-term dividend payers like the dividend aristocrats. So there's a number of these types of companies that you might want to consider. Another company, I've got some shares in Main Street Capital. Another company that I do like is AOS. They've been paying a dividend again for quite a long time. It's rated by analysts as in general as about a buy. It does have a relatively low dividend yield, a relatively strong 5-year average dividend growth rate. And A.O. Smith is a company I've been looking at for a while now, and I've been building a position in this for various reasons. And I'll put a blog post up about that in another video about A.O. Smith soon, and some of the reasons why I like this and some of the reasons why I think there's a lot of good opportunity to consider investing in this today. So in this way, the core satellite approach, you've got your core stable, you've got your core take some of the emotion out of investing. You've got a much smaller position in your satellites. You might have 5 or 10 satellite positions, each at only 3 to 5 percentage points. So if any one of these companies experiences a very severe downturn or a very severe decline in prices, you don't have that gut-wrenching horror, that shock, that disbelief that so much of your wealth has just disappeared overnight. And that, my friends, is the benefit of the core and satellite investing approach. So companies like A.O.S. Smith, that's going to be more volatile, certainly a good position and a good type of company then to consider as a satellite. Now, one of the other benefits is you can only have so many satellite positions in this respect as well, so it really forces you to be selective. It forces you to buy at good valuations. It forces you to select and really focus your attention. It focuses your investment research. It focuses your investment opportunities in a small number of stocks, which you must therefore be passionate about and really believe in. So, my friends, the core satellite investment approach, I do like it. I think it's got a lot of potential for you. And as we go through some more videos, you'll get more ideas about what you can do for each part of the core satellite approach. So, my friends, stick with me and stay around for another video soon.